Welcome to this explainer. Whenever we talk about the semiconductor space, it's usually the flashy designers, the big AI chip makers, or the race for the absolute smallest nanometer node that completely dominate the headlines, right? But if we look just beneath that surface layer, the foundries, the actual physical engines building these chips, are undergoing a massive fundamental shift. Today, we're going to unpack the recent Q1 2026 print from GlobalFoundries. Now, on the surface, this just looked like a solid, stable earnings report. But the market reacted with an explosive upward move. Why? Because the underlying mechanics of this company have been literally rewired for profitability. We're going to use the data and their own visual breakdowns to show you exactly how they engineered this massive market surprise.
Okay, let's dive into this. $3.45 billion. That's billion with a B. That is the massive block of value that was added to GlobalFoundries' market cap in just a single trading session following their Q1 release. The stock jumped a really impressive 9.28%, and momentum scanners were tracking peak intraday moves of nearly 13%. This wasn't just some gentle market rotation, you guys. This was a violent, rapid repricing of the stock by investors who suddenly woke up and realized the company's baseline financials had completely shifted. But big moves like this, they don't just happen in a vacuum. They happen when a company definitively proves that a long-term strategic narrative is finally actually bearing fruit.
And get this, Wall Street was absolutely bracing for it. If you look at the financial tracking platform StockTitan, trading volume surged to nearly 5.7 million shares. That's roughly 1.5 times the normal 20-day average. What does that tell us? It tells us institutional whales were circling. They were sensing a pivotal shift in the company's story. Now, earnings history for this company has sometimes seen mixed reactions in the past, strong rallies followed by notable sell-offs. But this time around, the sheer volume of capital positioning itself right ahead of the numbers signaled that Wall Street was anticipating a massive, massive profitability story.
So the crucial point is right here in the hard numbers. Revenue grew from $1.58 billion to $1.63 billion. That is a year-over-year increase of just 3.1%. Now, in the fast-paced tech world, a 3.1% revenue growth usually puts investors right to sleep. But the real story is in the very next line, non-IFRS gross margin, which is essentially their core adjusted operating profitability, expanded from 23.9% to a phenomenal 29.0%. That is a staggering 510 basis point expansion, or 5.1% in a single year. This right here is the real engine of this explainer. GlobalFoundries didn't just sell slightly more chips, they fundamentally changed how much money they make on every single chip that leaves their fabs. They extracted significantly more value out of basically the same revenue base. Now, you might be wondering, how on earth do you pull 510 basis points of margin out of thin air in a highly capital-intensive business? Well, you don't. This profitability was absolutely no accident. Management pulled 5 very specific levers to structurally transform their margins. First up is mix transformation. They are actively pivoting away from lower-margin legacy products to highly specialized, higher-margin tech. Second and third, we have capacity utilization and efficient capacity ramp. Basically, they're running their extremely expensive factories much, much smarter, squeezing way more efficient yield out of their equipment. Fourth is accretive acquisitions, buying bolt-on technologies that instantly boosts those margins. And finally, technology services. They're adding highly profitable software, IP, and service layers right on top of their standard silicon manufacturing. It's just a brilliant multi-pronged attack on inefficiency. And this brilliantly illustrates just how effective that strategy actually is when you compare them to the rest of the industry. Since their IPO back in 2021, GlobalFoundries has managed an incredible 800 to 1,000 basis point margin expansion. Meanwhile, look at their major foundry competitors. We're talking giants like TSMC, UMC, and SMIC. They've either seen totally flat growth or actually lost significant ground, with some facing 500 to 1,000 basis point contractions over that exact same period. GlobalFoundries is literally lapping its peers in the race for margin expansion. They are demonstrating a level of operational discipline that the rest of the legacy and specialty foundry market is frankly just struggling to match right now. So, the secret to those margins really lies in exactly what they are choosing to manufacture. For years and years, the foundry business was heavily tied to the smartphone cycle. But when you map out their projected revenue growth by segment through 2030, it tells a totally different story. Smart mobile devices, essentially flat, sitting at around 2% growth. They're strategically shifting their capacity away from the stagnant phone market. Instead, check out automotive, which is growing at a very healthy 9%. And the absolute standout here, communications infrastructure and data center, projected to grow at over 30% annually. They're taking their entire massive manufacturing ship and pointing it directly toward the booming, high-margin secular growth areas fueled by the AI and cloud infrastructure megatrends. Of course, to service those wildly different high-growth markets, you need a very specific physical footprint. It's not just about building one giant megafab anymore. It's about having the right facilities in the exact right geopolitical regions. This brings us to the physical chassis of their business. Over in the United States, they are heavily focused on auto and defense-grade sites. This provides extreme security, localized supply chains, and all the strict compliance needed for highly sensitive government and automotive contracts. Now, contrast that with their operations in Singapore, which are currently ramping up highly efficient, ultra-low power, or ULP, CMOS production. That's the crucial tech needed for everyday connected smart devices. They are perfectly matching their regional capabilities to specific market demands, and they complete this global chessboard with their operations in Dresden, Germany, and their footprint in China. By maintaining this fungible, highly diverse footprint across North America, Europe, and Asia, GlobalFoundries is offering something incredibly rare in today's really fractured world. They give their global customers geopolitical security, technological differentiation, and massive, massive scale. Think about it. If a supply chain shock hits one region, they have the flexibility to adapt. In a world where semiconductor manufacturing is increasingly viewed as a critical matter of national security, having this expansive multi-continent footprint is a huge competitive advantage.
Okay, so with the margins, the markets, and the footprint all secured, what do they actually do with the cash? Well, they feed it into a strict capital allocation flywheel. This is the financial engine that's driving shareholder value. Step one is self-funded organic growth. They reinvest heavily in their own profitable technologies. Step two, once they've funded their own growth, is pursuing disciplined, strategic M&A, but only with very strict return on invested capital hurdles. And finally, step three, they reward investors by returning that free cash flow to shareholders through opportunistic buybacks and eventually a future dividend. This is a mature, super sustainable loop. They aren't just burning cash to survive, they are strategically deploying it to compound their advantage. Let's move to and see how this builds into an undeniable long-term trajectory. Back in 2021, their gross margin was just 16%, a fairly standard, somewhat low margin operation. But by 2025, they had driven that up to 26%. And their target for exiting 2028? A staggering 40% to 45% gross margin. They are completely transforming from a volume-dependent utility into a highly differentiated, high-margin technology partner. This timeline right here perfectly encapsulates exactly why the market suddenly added $3.5 billion to their valuation. Investors aren't just buying the present. They are buying this very clear, highly credible line of sight to a 45% margin powerhouse by the end of the decade. Which leaves us with this final, profound question to consider. As the artificial intelligence revolution continues to accelerate, and as data centers desperately transition to advanced technologies like silicon photonics just to handle massive data loads, the physical realities of chip manufacturing matter more than ever before. The industry needs scale, it desperately needs geopolitical security, and it needs specialized, high-margin innovation. So, looking at the structural transformation we've just unpacked today, is GlobalFoundries' unique, globally diversified model the ultimate moat for the next decade of semiconductor megatrends? They've built the engine, they've proven the profitability, and now we get to watch how they capture the future. Thank you so much for joining me for this explainer. I really hope this helped you see the brilliant mechanics under the hood of this massive market movement.